Welcome to Tampa Home Talk with your host, native Tampa real estate girl, Katrina Madewell, a full-time, passionate, out-of-the-box thinker, love for home ownership kind of realtor with over 21 years of combined mortgage and real estate experience. Tune in every week at this time for expert advice on everything you need to know about home ownership, finance, maintaining great credit, building wealth, and making your everyday life better, and how you can be financially successful today and tomorrow. Remember, love where you live or let Katrina fix it. Now, here's your host of Tampa Home Talk, Katrina Madewell.
Good afternoon. Welcome to Tampa Home Talk. Thank you so much for joining us today. You can catch us here every Thursday and Saturday at 5 p.m., 1340, 1350, and 1400. We got a great show lined up for you today, and we are taking your questions. You can tweet them to us at Tampa Home Talk. You can also post them on our Facebook page, which is Tampa Home Talk, and we will be happy to answer them on air today. Our off-air call-in number, if you would like to reach us, is 813-936-2302. Again, want to jot that down, 813-936-2302. So we've had a lot of questions that we get all the time around home buying and the home buying process and the first-time home buyer and what goes into that. The rules of buying have changed for sure. Anybody that's bought at the peak of the market and has tried to do that again realizes that you no longer have to just fog up a mirror in order to get a loan. You actually have to have an ability to qualify. Imagine that. So we'll take some calls and answer some questions as we go today. But I thought, first of all, I would explain what a first-time home buyer is. Like, what's the definition of first-time home buyer? And that would be anybody that has not owned a home before or in the prior 3 years. And there's a lot of different down payment assistance programs and different programs that you might qualify for if you have not owned a home in the last 3 years. So in studio today, I actually have a special guest. My mom's hanging out in the studio. We got some family that's in town, my mother-in-law. So Monique, Chrissy, I'm probably going to see if they can hop on air with us today. But and we got some questions that are going to come in. And I know, Chris, you're going to chime in and give me a couple too as well. But so some of the questions, and a lot of this prompted from Lori Zook's show. She's here at Tan Talk on, Saturdays at 11? Is that right?
No, tonight at 10.
Oh, tonight at 10. Thursdays at 10. Leave it to me to get it right. Thanks, Chris.
Tonight at 10 o'clock. I got your back.
So it was just a great show. I think she's airing that one. A lot of similar content in the future. But, some of the things we talked about was pre-qualifying versus being pre-approved. And so pre-qualifying versus being pre-approved means someone has either just ran quick numbers and a credit report and that kind of stuff versus actually verifying a lot of your documentation. So there's a big difference between pre-qualify and pre-approved. And so essentially you want to make sure that you're actually pre-approved, especially if you're self-employed or anything like that, because essentially, with your self-employed, you have to think about write-offs, right? Every self-employed person has that stuff. And essentially, if you're writing stuff off, they're only going to give you credit for whatever the net income is going to be, not including anything that you grossed. So minus those expenses, we're going to give you credit for. And they're going to average it out over a couple of years. So, and did you get questions that came in, Chris?
I do have some. I'm actually a first-time home buyer.
Well, give me one. What do you got?
What's the first step? What's my first step?
First step, I would say, is to get pre-approved. Before you do anything, before you even start looking, okay? Even if you're a year out, we tell people to get pre-approved, which is kind of what I mentioned a minute ago. Have your credit report pulled. Make sure there's something on there that's no surprises, especially if you have a common name. It's not uncommon that we see juniors and seniors with mixed credit. So there's a lot of reasons why you might want to have a look at your credit report. Some of the rules have actually changed too from prior years. Like for example, the lenders used to disregard medical collections, and now they don't. They actually pay attention to those, and a lot of times they have to be paid off or settled. There's different circumstances, but they're going to look at your debt to income ratios. They're going to look at your housing history. So for example, right now, if you're renting, Chris, you might want to make sure you're writing a check for your rent as opposed opposed to giving your landlord cash.
Why?
Or because especially if you have a limited amount of credit, and I don't know if that's your situation, but they always like to reference that history for the last 12 months, especially if it's not with like an apartment complex or a property manager. They are going to want to track that, and it's not uncommon for them to ask you to pull 12 months of your prior rental history via canceled checks.
Okay. I would have never thought about that.
Exactly. So get pre-approved, even if you say, hey, I just signed a lease and I'm not going to be ready to move here for another year. That way, if there's any little hiccups on the credit or anything like that, we have plenty of time to fix it and get that stuff off of there. And
Okay.
the other thing, too, go ahead.
So I go through all that. I pull my credit scores. I have all those ducks in a row. How do I know if I'm actually ready? Like, it's one thing to actually go and do all that stuff, but what if I do all that and I'm not ready and I think I am?
Well, the next thing is essentially you're going to want to make sure whatever you think you're ready for, you qualify for.
Okay.
And so you're going to take that and look at whatever your rent payment is. What's your rent payment?
700.
Okay. So we're going to look at what your rent payment is, look at your income, and then calculate how much you qualify for.
Okay.
Based on that, we're going to let you know. And they also have funky little underwriting terms like payment shock and stuff like that. If your payment adjusts too much,
Yeah,
underwriting looks at those things.
That's gibberish to me.
Exactly. So some of the benefits that you like, well, there's detriments and benefits, right? So how do you know if you're ready? That was a good question. So to tag on to that, not only do you want to know what you're qualified for, and we recommend once you know what that number is, we'll go ahead and set you up on a portal. That way you can kind of look online, right? You're going to window shop. Sometimes people window shop for a year or more before they ever even take the next step and start physically looking inside properties. And that's really good if you're doing that, because then you get an idea how much stuff costs, right?
Right.
If you want to buy a truck and you're pricing F-150s, but you're not quite ready to buy it, but you know in the next year you want to buy an F-150, you're probably going to pick up an Auto Trader and start looking through there. Even though you're not physically test driving any trucks, you're going to start looking at those vehicles to get an idea of how much they cost, for what year, for what miles, just to get a general idea.
But now I'm impulsive. So when I pick up that Auto Trader and I start looking at that Ford F-150,
You're ready to go test drive
a
it.
week later, that Ford F-150 is in my driveway.
So people like me help keep you grounded so that we can set you up for success so that you don't fail.
And that's exactly it. I understand that. I just can't do
That's why you
anything
don't
about
want to
it.
look.
Yeah, I
So the other thing too, let's talk about down payment, because that's another issue that we get all the time. People ask those type of questions, and we have everything from small to zero amounts all the way up to bigger percentages requiring different scenarios. So for example, some of the best programs we have that are zero down, obviously if you're a veteran and you've served the country and you've got a DD-214 showing that you've had honorable discharge, you can buy a home here and anywhere with zero down payment, and the VA will guarantee that you will make that payment on time. Their theory is, hey, if you served in the military, you got honorable discharge, you did your part, we're going to guarantee a loan for you when you come back. And that's something that they started after the wars many years ago. And so essentially, we see a lot of our veterans, they might give an escrow deposit of $500, and then sometimes they don't have to bring anything else to the closing table. Like, that's it.
Okay, now I've always, I guess, thought or been told, maybe not by the correct people, that 20% is what you want to put down.
A lot of people tell you that, and I'll tell you why. Not yet, though. After the next segment, I'll tell you why.
Because they get more in their pocket.
No, that's not why. That's not why, actually. I'll tell you, there's a reason why the whole 20% comes into play.
Okay.
So the next thing, like if you're still looking for, let's say you're looking for a zero down program, but you're not a veteran, so you haven't served the country, you don't have a DD-214, the next best program probably would be the USDA, the Rural Housing Program. Now, if you live in Clearwater or Pinellas County, you're out. You're not going to be eligible for that.
Why?
Because the whole area is no longer considered rural, and it hasn't been for years. So USDA will not, it's a government product, they will not guarantee that. It's very much based on census and where you're located, as well as income. There's some income restrictions, but they're pretty high, I think.
Do they just break it down rural and urban?
Pretty much, yeah. There's literally a map.
Just one or the other?
You plug the map in, the map will tell you if that area is eligible or not. Like right now, if you're looking at a map of Tampa, essentially it's going to be like where the Veterans Expressway is. When you get near like Trinity area, Newport Richie, all that area is still out. You have to be on the east side of the expressway, the Suncoast, and then it keeps going. And really right about where County Line Road is, between Hillsborough and Pasco County, that area still qualifies. And believe it or not, some of New Tampa still qualifies.
And so now it's better to be rural?
Well,
I would assume?
here's the thing I like about that product, and here's where the 20% comes into play, which I'm still not going to explain yet, but I will. It doesn't have what they call mortgage insurance. And so mortgage insurance, all right, I'll dive in. They say 20% down.
Got ya.
I can't help it. 20% down because that helps you eliminate PMI or private mortgage insurance or MIP if it's a government loan. And some people think, oh, I have mortgage insurance. That's a good thing. If I die, my loan will be paid off. Negative. That's not how it works. So mortgage insurance, that's credit life, what people are thinking about. Mortgage insurance only insures the lender against default. So if you don't put 20% down, they make you buy this private mortgage insurance. It's mandatory so that if something happens or you default or you stop paying, they have an insurance policy to guarantee that when they take the house back and resell it, they're not going to be in a negative position. They won't lose money.
Okay. Now, I didn't know any of that aspect of the 20% down. For me, I just assume putting 20% down is great because it's you get a shorter term, you get
not
maybe a better interest
necessarily.
rate, or you get less that you're actually financing.
Right. And people think, here's another good point, too, that you actually just touched on. Sometimes we have people, like older people, I've had people in their 50s and 60s that come to us and they're buying their house for the first time. And they're like, I want to see if I can qualify because I know I can't get a 30-year mortgage, but I just want to see how, if I can afford a 15-year payment. And that's a complete misconception. So that is not accurate at all. It doesn't matter if you're 85 years old. The bank cannot deny you from getting a 30-year loan. They cannot. Okay.
Now, if I were, how do you determine how much house you can buy?
So the rough rule of thumb is 28% housing ratio, 30% back end. And how you calculate that.
Now, what does that mean?
I'm going to explain it. So if you
I told you this was gibberish.
I know, right? So roughly speaking, like let's say, give me a generic income figure for the month. Just give me a generic.
For the month? Or the year?
Gross monthly income per month before taxes.
Okay, how about $2,000?
So $2,000. Okay. So if we're working with $2,000 a month gross monthly, they are actually going to take 28% of that figure. I'm looking for a calculator on this darn thing. But 28% of whatever $2,000 is what your housing allowance should be. And there's nothing to say that they won't actually go higher than that. But those are the general rule of thumbs that they look for whenever they're trying to calculate you.
Okay.
So $2,000 a month times 28%.
$560.
$560 housing payment. And that's total. Principal, interest, taxes, insurance.
Okay. So that's, in theory, how much you could afford if you
That's your payment.
Okay.
Yeah. Now, keep in mind when interest rates go up, right now they're really low. But as interest rates rise, then your buying power goes down. So that means, right now we're seeing rates in the high 3s, low 4s. Once those rates hike up to 5, 6, 7, I mean, when I started in the industry, they were 12%. And, you ask your parents, they might have told you they were 18 or 20.
What's a good interest rate now?
It's kind of like saying, I want to buy stock in Apple. What's the price of the stock? Well, it depends on exactly when you buy it because it's a publicly traded company and it trades. It's the same thing. Bonds trade with Wall Street. And so that's going to change the cost of money. Like basically the way it works is the Federal Reserve essentially they buy money at a certain price, right? And then they relend it to make their profit. And right now the Federal Reserve is almost zero. I think it's like, I'd have to look it up to see, but it's like 0.25 or a half. That's how much they borrow. They borrow money at that rate and then relend it at like 3.5%, 4%.
Okay. Now, in determining my interest rate, is there anything other than my credit score that is going to change that?
Absolutely.
If I put more money down, can they lower my interest rate because I'm putting more money down?
Not really. It wouldn't change as much as one would think. They do have pricing calculators like in the background where they plug that stuff in, like your loan to value is what you're talking about. Meaning, okay, if I went FHA and I put 3.5% down versus conventional putting 20% down, essentially you're taking that amount and it's not, the government rates, believe it or not, at 3.5% for FHA are better than conventional.
Okay.
Because they're government-backed loans.
If I said to you that I had $25,000 to put down on a house.
Okay.
And I made $40,000 a year.
Okay. So
what is the maximum value house that I'm looking at?
Well, $40,000 a year. divided by 12. They're going to give you a gross monthly income credit of $33.33
Okay.
and 33 cents. And so essentially based on that, they want your housing ratio to be around 28%. So
Okay.
that exact number is like 933. So I would say you probably would qualify for about $1,000 a month. So let's say in their back end
$1,000
ratio
a
a month
month.
housing payment. Yeah, total payment.
So my monthly mortgage payment could be up to $1,000.
Roughly, yeah. Now, if you didn't have any other debt, like let's say you didn't have a car loan, you don't have any credit cards, you don't have student loans, you have no other debt, they can give you a little bit of leeway and essentially look at that back end ratio, which allows for those other things. Like that's the difference between the 28 and the 36%. And in recent years, we've seen where it goes through automated underwriting. It's like a computer underwriter. They put all the data in and it kind of spits out what they call an accept or a refer. Accept means they're going to approve it. Refer means it doesn't like something about it.
Okay.
And so sometimes they can manipulate that system to fix whatever it is. Sometimes it's down payment. Sometimes it's debt. Sometimes it's credit score. It might have a collection in there it didn't like that they left open. They might want to see that balance at zero before it would take it. So that's one of the things that we would do would be to put it in automated underwriting to see what it's going to take, because that's what makes a loan saleable. And that's that's how the lenders make their money. They package these up in multiples of $1 million, $2 million, $5 million, and they resell them on the secondary market. So what that means to the consumer is, like, let's say you're paying your mortgage payment and they go, oh, they sold my loan. I had BB&T, now I have Wells Fargo or Chase or any of the big dogs that service loans. That's what they've done. They bought your loan in the middle of a bunch of other securities and they're servicing it. They're called a servicing lender at that point.
Okay. Now, again, this may not work for me because, like I said, I am very impulsive. Mm-hmm. But for the people that are very good about this process, which I would probably say that I am not one of them, if you are just window shopping and you are looking for 6 months or a year or 2 years, like you said, how do you know where that maximum is? Like total, like if the house is $125,000 house, is that too much house?
For that price range?
Right.
No, I think you'd be right in line. You probably have a lot of wiggle room. And that's a crazy thing is like you may look at one house that's $125,000 and another one's $125,000 and the payments might be very different. And
why?
Well, because there's going to be a number of things that can affect it. The main thing that would change would be your taxes and your insurance, okay? And where the community's located.
I was going to say zoning or whatever.
Well, sometimes, I mean, the municipalities and how they're zoned have different tax millages. Different tax millages warrant different tax rates. So yes, that is part of it, but it's a very small part of it. We also have what we call homestead exemption here. So for example, let's use the $125,000 house that you gave as an example.
Okay.
If you file for homestead exemption, they will likely take $50,000 exemption off of that, which means you're only going to get tax assessed at $75,000. So at that point, and since our taxes are paid in arrears, meaning when we get the tax bill at the end of the year, it's going to be for the whole year that has already passed.
Okay.
So let's say, you're buying a home mid-March, okay? They're going to use the tax bill based on last year. Now, that may or may not have homestead exemption. So if it's a bank-owned property, the homestead exemption is probably off, which means your payment's going to start out a little bit higher. And then after you file for homestead exemption and your tax adjust, your payment's going to go down because you've got that exemption on the property the bank's not able to get because they don't live in it. Another thing that might affect it would be the age of the home. Not only the age of the home, but also when it was built, how many upgrades and improvements have been made. Insurance companies, they now require what they call a 4-point inspection. And so the 4-point inspection is going to look at those 4 key points that insurance companies look for to be upgraded. So your electrical panel, your plumbing, your roof, and your AC system. They want those things to be in working order. And if those things have been upgraded, then they know your house is nicely insurable. If you haven't had those, or let's say, in the roof, it's got to have 2 to 3 years remaining life or you're not getting a loan or insurance anywhere. So it's another little piece to take into consideration.
Just the roof?
Just the roof, yeah. But there's a number of things. Like let's say you have a home, like my mom, for example, she had an old home with a knob and tube wiring. Remember that?
Yeah, tube made on telephone poles.
Talking here because you can't hear it.
Made on telephone poles.
Yeah, so the knob and tube wiring, they won't even insure that. Like you can't get an insurance carrier in the world to carry it because it's a very old, outdated electrical system. They consider it a fire hazard.
And every so many years, an older home, they ask you to do a 4-point inspection again.
Yeah, they're going to have
Especially
you.
if it's an older home.
Yeah, they want you to keep updating, talking to the mic because nobody can hear you like in the background.
Listen, my voice is not good today anyhow.
So anyhow, that's something else so if you bought a newer home, Chris, one that's really nicely insulated, or it's a lot newer, like let's say you bought something in the 70s or 80s compared to something built in 1930, the building codes have changed. I mean, look at when Hurricane Andrew hit Miami. I forget what year that was, but it was early 90s.
Yeah, 93, 94.
Yeah,
maybe?
and then after that, remember we had the back-to-back hurricanes, 10 years later?
Well, I wasn't here yet.
Well, the building codes changed, is my point. Like
Okay.
every time those major storms come through, they change the building codes. So they're gonna, and the way the insurance companies do it now is they start your premium up here. It might start at like $2,000 or $3,000 or whatever, and then they're gonna give you credits based on what you have. So like if your electrical's been upgraded or you have a new roof, all those things are gonna give you credits, and that may bring a $2,000 or $3,000 premium down to $800-900.
Okay. I have two other things that I kind of want to touch on, but I think we can probably get to that on the other side.
Well, let's give a little teaser, and then we're going to take a break, and we'll answer that when we come back. What's the question?
One is foreclosures.
Okay.
And, obviously, I hear people talk all the time about getting a better deal because the house is in foreclosure. So I
love that. I love that thought. And we are going to answer that question as soon as we come back from a break. We'll be back in a minute.
You've heard this before. Interest rates are at all-time record lows. But if your interest rate is 4% or above, you owe it to yourself to call Silverton Mortgage Specialist. Silverton is a direct lender, and the best part about this is that the entire loan process is handled in-house. From application to close, we do it all in the same building, which means that our loans close fast and our clients know what's going on every step of the way. Our contact info is located on TampaHometalk.com under Radio Show. What makes Silverton different? Products. We offer VA, FHA, USDA, and conventional loans pricing. Best rates with the lowest closing cost. Process everything in-house. It's handled right here and not outsourced to anyone that no one can reach. This way we can avoid surprises. Our people are simply the best, and we know you'll agree. What will closing Silverton Mortgage Specialist mean to you? A smooth process, real home loan value, and personal attention from real professionals. Silverton Mortgage Specialists are here to serve you. Visit TampaHometalk.com under Radio Show for all of our contact details. NMLS 109600 is an equal housing lender and Florida and Georgia residential mortgage licensee.
Aaron Davis here, owner of Hillsboro Title, serving all of Tampa Bay. Our service strength and knowledge make us different. From Polk County to the Gulf, Pasco to Manatee, Tampa Bay, we've got you covered. Visit us on the web at thebesttitle.com. That's thebesttitle.com.
Welcome back. You're listening to Tampa Home Talk. Thanks so much for joining us today. You can catch us here, same time, same place, every Thursday and Saturday at 5 p.m. We're also available across the web on Facebook and Twitter. Just look for us at Tampa Home Talk. And you can catch all of our shows via a podcast. So if you missed any of our lovely conversation today, you can catch the whole show in its entirety. So during the break, I had a question come up because when we started the earlier segment, we were talking about what classifies a first-time home buyer. And so sometimes people think, oh, well, I owned a home a long time ago, or I got foreclosed on, or I sold that home, so I'm no longer eligible. They classify the first-time home buyer as someone that has either never owned a home or has not owned a home in the last 3 years. So as long as you have not owned a home from this date to 3 years back, anytime prior doesn't matter. You're now a first-time home buyer.
Okay.
So I just wanted to clarify that because I think there was some misconception around
Yeah,
it.
I would assume you had to be a first-time homeowner,
How
but
long between
that's good.
if you have a foreclosure and
So
you have
for-
to wait the 3 years?
So I got a couple extra guests. I got how many? 1, 2, 3, 4, 5 guests in the studio that none of them want to talk. So we're going to answer questions.
If you've been foreclosed on, how long do you have to wait? You have to wait the 3 years to go in to be a
Foreclosures, usually they're going to want to, it depends on the scenario. FHA lets you repurchase again after 2 years. And keep in mind, at the time of this recording, those rules can change. Like FHA can change stuff on a whim next week, and those rules can be different. I will tell you that if you've had any issues like a bankruptcy or a foreclosure, they're going to be looking very closely at your housing history. So, for example, if you had a foreclosure, you should pay definitely with canceled checks, because they're going to be looking for your on-time payment history.
Well, supposing your foreclosure had a sinkhole.
They do look at extenuating circumstances, and so they may put a letter of explanation in there. But the general guidelines, like even conventional, it has to be 3 years. They won't let you purchase again without it. Now, people do purchase with private money, which was something I was going to talk about a little bit later. We have private money investors that will lend. You can put, for example, 35% down, and it doesn't matter. You could have filed bankruptcy yesterday. You can still get a loan.
What kind of rate do they give?
The rate's going to be higher. I mean, you've got an investor.
How much higher?
Oh, it depends. The investors let us know. I mean, those are going to be, you can borrow conventional money right now for roughly 4%, give or take, depending on the scenario. So you're looking at least probably 10%. It's private money. You got somebody that's going to give you $100,000, $200,000, however much you're asking for. Right. They're probably moving that money from the stock market or another place and putting them into private funds. So you have to just keep that in mind. It's risk, right? And if the bank won't give you a loan, there's a reason, right? There's something they don't like on it. So someone else is willing to take that risk with a higher rate of return. If you were lending your money, you'd be looking for the same thing.
Absolutely.
We have a caller with a question?
Yeah, we do. Caller, are you there?
Hey, Katrina. It's Echo and Emily.
Hi there.
Hi, how are you?
Good. Welcome to Tampa Home Talk.
Hi, we just wanted to say hello and see how it's going today.
Where's your first-time homebuyer question?
Well, I had actually wrote some down because I get this very often, is some of these questions. If I have a low credit score and I don't have much to put down, how do I know that I can qualify for a home?
And that's a good question, too, because sometimes people will think that their credit score is low, and then when we actually pull it, it's not as low as they think. So, conventional guidelines and FHA, here's what they say. They tell you they'll go down to a 580, but I can tell you those loans are very hard to do. They end up picking them apart and putting everybody through the ringer. Might close, might not close, like 50-50 shot. Your credit score really ideally should be at 620 or higher to purchase. We do get a lot of them through that are above the 600 mark, but, to be honest with you, the last couple that we took that were under 600 were just that they were so hard. It was like dragging the customer through mud. And we're like, we just made the decision as a company that we weren't going to write anything under 600. We were going to do what we could to help the client grab those 10 or 20 extra points, because it's going to be a lot easier, better on them, and their experience is going to be so much better than if we try to drag them through a lender that's going to drag them through 5 rounds of conditions, which doesn't make a lot of sense to you. But essentially, underwriters will do what they call condition the file, which means they're going to give you a list of things they want. You'll turn in all those things, and they'll give you a list of 10 more things. And you turn in those things, they'll give you a list of 10 more things. And you're like, I just gave you my bank statements for the last 6 months. Can we close already? Like, that's kind of how the scenario can go. And they can take a very long time. So I do not recommend it, even if somebody says, hey, yeah, we write credit scores all the way down to 580. Guess what? We could too, but we want you to have a good experience, and we're not going to drag you through that. I would much rather take the time and have the client, help them get a little bit of patience. If there's somebody like you, Chris, that's impulsive and they want to buy right now, yesterday, help them figure out a short-term plan to get that score up as quickly as possible. And there's a lot of things we can do looking at the credit to tell you what to do to increase that score. Then your experience is going to be so much better going through the process than trying to, drag you through it with a low credit score.
How much money can you expect to save by raising your credit score 20 points?
Well, I mean, those rates are higher. Again, they're taking the risk. So it might be anywhere from 0.5% to 1% from a credit score that's, below 620. And like if you're above 720, they're going to give you a premium credit. So that may actually sometimes bump you just 1/8 lower on the interest. It's 1/8. It's 0.125%. So it's not huge when you're talking about it. But comparatively
over 30
speaking,
years, right?
Right. If you add it up over 30 years, it adds up.
Right. Yeah, absolutely.
I see these things like on Craigslist and stuff all the time, and I always think to myself like maybe that they're scams. But there's these little ads that, you know, they say, oh, any credit, you know, we can get you a house now. Look at them and I wonder, you know, what are they going to hit you with? What's the fine print on that? You know, if they were to get you in and take you in.
I mean, that's a good question. You know, for the 22 years that I've been doing this, I have seen a lot of crazy stuff like that. And even going back to myself, right? Because I wrote loans and mortgages from the time I was 18 years old. I remember responding to something like that because I didn't, you know, at the time I didn't even realize there was a USDA housing product. I just, you know, I did loans, but I was very young at the time. So looking back, I mean, I responded to a couple of those, and I can tell you when I read the fine print, it was not good. I mean, some of the ones
that's who they prey on.
That's right.
They prey on these people that don't know any better,
right.
And you know, these people, a lot of young people. And, you know, people that just don't read the fine print and just go blindly into it. And I'm one of those people, you know, I'm not an impulsive buyer. I have to pick everything to death before I commit to anything. And so, of course, you know, I'm going to look into it further, but they don't want people like that. They want people to just, you know, go ahead and commit without even knowing what the details are. And you could really hurt yourself there.
The ones that I've seen are like that. And the other thing you have to be leery of, too, is sometimes it's not even their house. We see this all the time. People will try to intercept money. It's not even their house to rent or sell. Yeah. And then they're gone. And you're like, hey, I gave you a deposit. What happened? That should always be placed through a title company or an attorney. You should never give.
I think it's worth it. I mean, in my opinion, I think it's worth it if you are considering buying a house. It's not that hard to work on your credit score. Like even if you have a low score now.
Right.
I mean, if it's something that you're planning on, you know, you have to put some planning into it. And if you're planning on buying a house, let's say within the next year, I mean, you can take that year and work on building your credit up because it's not that hard to do. I mean, let's say if you're even at like a 300, if you have a really bad score, I mean, you can take
I don't believe it or not, I don't think I've ever seen a 300, which is good.
Yeah, I mean, you can bump it up, though. I mean, just work on it little by little, and when you're ready, you know, it makes it that much easier.
You'd be surprised. I mean, a lot of times when we run credit reports, we may look at a credit and, you know, somebody may have $1,000 limit on a credit card, but they've got $900 on there. And if they're at or over limit, that's going to significantly impact the score. I mean, that may bump you down 25 to 30 points, right? And we're talking about these ones where we're trying to grab 5, 10, 15 points. You can see how that would be easy. So a lot of times, if we're just trying to grab a few points and somebody has credit cards, we'll have them pay that account like down to $10 or almost all the way off. A general rule of thumb is if you have credit cards, and we're not big advocates of credit, we want you to pay cash for everything if you can, but you want to keep that balance 50% or less and then really pay it off if you can. You know, if you're trying to establish credit to buy a house, it's a real good idea to have that stuff available because you want to have at least 3 trade lines if you can, you know, and they'll use rent as one of those, like non-traditional housing, that kind of stuff.
Yeah, and I was, you know, talking, and I've heard now that actually buying a home now, even at being a first-time home buyer, it's a lot more inexpensive, I guess, if you will. I think rent is going up this year, supposedly, and it's going to be, you know, a lot more expensive to rent than it is to buy.
Well, that's what they call inflation, you know, and the hedge funds are still here purchasing, so that's a good sign because that means that the rent prices are still going to continue to go up. And if you can buy now while the interest rates are as low as they are, that's a win-win because, you know, your housing payment really is not going to ever change very much. It'll change a little bit based on your taxes and your insurance, but it's very minimal. We have the Save Our Homes exemption, so it can't go up any more than 3% per year, and that's of the tax bill.
Yeah.
So thanks for calling in, ladies.
You are very welcome.
Any more questions?
No, that's all. Well, she might have something.
Katrina, do you want to talk about, like, a lot of people asked about student loans. Does it hurt their chance to get a loan?
Student loans are a good one because a lot of times we'll see them come in where they're in deferment. And it's one of those tricky things that you should leave alone until you talk to your loan officer, and we'll guide you exactly correct. Because what happens is if we're not counting, and it has to be deferred for 12 months to not count it against you. And anybody that's been in school and has a student loan will tell you they only defer for 12 months at a time. So you're thinking, well, how am I going to do that? Real simple. Right before they go to give you a loan, you're going to put it back into deferment. They're going to re-verify it and then push you on through.
All right. Yes, thank you for answering that.
That's a good one we get all the time. I know we had someone else call earlier that was asking about self-employment and getting a loan when you're self-employed. And we see this one a lot. And it's not like a regular W-2 income employee. You know, if you get a 1099 or you're self-employed, they're going to want to see all of that income. Basically, they're going to look at your expenses. So, you know, if you're making $100,000 a year, but you're taking $80,000 in expenses, they're going to give you credit for 20. And they're going to average that over 2 years. And sometimes, you know, we see a lot of times with our self-employed buyers, they may have to wait a year or two to buy because they're going to average their tax returns over a couple year period. And it's a lot of it's very strategic. They have to plan on exactly what they're going to show. You know, they have to run numbers with their CPA to make sure they get it right and then run it through underwriting. Because, I mean, I'm talking every I has to be dotted, every T has to be crossed.
Right, and that's, another question, you know, or something I wanted you to bring up was that's why it's so important to get pre-approved before we show you home.
Absolutely. We talked about that in the beginning. You know, if you ever have an agent that is showing you properties and you haven't been fully pre-approved, I would say buyer beware, because there's no agent that has been doing this for any period of time that knows a lot about contracts, that knows a lot about all the ins and the outs. They're not going to take you to see properties. We have a due diligence as a realtor, which means we abide by a certain code of ethics, and we can't just take people through sellers' homes that haven't been pre-approved. And, you know, you have to look at this from the seller's perspective, too. We're asking the seller to vacate their property. Sometimes that means swooping up a couple of kids, 2-3 dogs, and they have to, you know, keep the house clean, get everybody out, and vacate for an hour while someone comes between 6 and 7 p.m., right? Yeah. Which is right at dinner time. It's not the most convenient thing to sell a house. So we have a due diligence as agents to make sure that the people we are taking through the home are qualified and they're approved, you know, and any smart agent. I mean, look at the news, right? We've seen these agents that get killed in properties. Those are people who we call them Pop-Tart agents. That's our background, like the Pop-Tart agents. So they call and says, I want to look at 123 Main Street. Okay, I'll be right there. Like there's not a whole lot of, like you're setting yourself up for a disaster, you know? You have no idea who that person is. You have no idea if they're trying to just see the inside of the home to come back later and rob it. I mean, there's so many things and so many reasons why you would not want to just meet somebody to property and run in and show it to them. And if you're not getting a loan, you're paying cash, that's fine too. But we're going to be looking for proof of funds because the seller's going to be looking for it too.
And if you have an agent, they're going to usually go
right
at it first.
So, your good agents are going to be asking those things. If they ask you to get pre-approved, it's not because they're being nosy. It's not because they're being pushy. They just want to make sure they're looking out for you and your best interest. If they take you and they show you a $200,000 house and you're only qualified for $125,000, guess what? You're not going to like anything at $125,000 when you looked at $200,000 houses. So, I mean, it's, you can't have champagne taste on a beer budget. So you got to get whatever that budget is in the beginning and get that all ironed out so that you can make one work that's within your budget. And you got to start somewhere, right? You can always trade up later. Any more questions?
Good show.
Oh, I think they're gone.
Well, I know that when Lori was on, we didn't have a whole lot of a chance to talk about this, so I thought I would share it today. But we get often asked a lot of times, what's the difference between a deed, a mortgage, a note, a loan, all of that stuff? And there's pretty substantial difference in them, and I was talking about Florida being a lien theory state, which means as opposed to places like Georgia and some other states, you have to pay the entire house off before you get the deed to the property. Those are what we call title theory states. In Florida, we're a lien theory state, so that means essentially they will go ahead and give you the money and the deed, and then they're basically going to secure their interest, meaning make sure you pay them back by recording a mortgage on the property. That's their security instrument or the collateral that says, hey, if you pay, you stay. If you don't, you won't. And so
fair enough.
That's right. And it's about 14 or 15 pages that let you know that.
And no one ever wants to read that.
That's right. I think I'll do a whole show just on what the mortgage says and what those provisions are, because I could probably read them in my sleep.
Yeah, because there's not enough paperwork and documents and signing.
Well, people always say, what is this? It's 14 or 15 pages, and you're telling me if I pay, I stay. If I don't, I won't. That's right, But there's a lot of other things in there. Like one of the things I saw them change in mortgages over the recent years was the provision that if you're in default on the loan or the mortgage, you can't collect rent payments from a tenant. The bank will intercept those fees now and take it to put it on your loan. That's something
Really?
they've changed recently. And in prior years, that was never on there. So, you have a crazy scenario like we've had over the last several years after following the housing meltdown, and you have people that have been in their home for 2-3 years. You have attorneys trying to sue for discovery, which can be another whole show in itself. But they can stall that process. And, at the beginning of 2015, which is where we're at now, they essentially they're pushing a lot of that stuff out of the system. So we don't expect them to stall too much longer. In a normal market, after 90 days, you can pretty much expect to be kicked out. But that hasn't been the case in the last several years.
So you do see often situations where the homeowner, like you said, is renting the house. They're getting the rent payments from the renter.
Yep.
Which should be then going towards
The bank.
the mortgage, but it's not.
That would be morals.
So now, does this happen a lot where
It has.
now the owner is basically going into foreclosure and the renter has no idea what's going on?
I'm glad you brought that up. I'm going to talk about that.
What does the renter do? They didn't do anything wrong.
Well, I had a scenario
They've
actually.
got a sketchy
That's
homeowner.
right. But here's the thing, and here's the way the courts look at it. The courts look at that scenario, even though one would think the renter is paying their rent, they should be paying the mortgage. The court's going to look at that as two separate contracts with two completely different parties that have nothing to do with each other.
Which
So
means what?
the bank's contract, which is a mortgage, right? They have
Yeah.
a mortgage contract, and the promissory note, that's what the note is, says that's your agreement to repay this money that we've lent you. If you don't, the mortgage is what allows us to take it back. That essentially that's their contract with the bank. So the seller or the homeowner has made a contract with the bank to make these payments of X amount over 30 years, and then the house is theirs. There's no more lien.
Right.
That's their agreement and their contract with the bank. Now, if the homeowner decides, this house is too small, I'm taking a job out of state, whatever it is, and they want to rent their home, they entirely have the rights to do that. That's a provision in the mortgage that says they have the rights to do that. And this is the little thing that they've changed, because what would happen is, the homeowner wasn't paying their mortgage, yet the tenant had been faithfully paying their rent on time. They want to pay it 10 days late, and the landlord wants to charge them a late fee, which they can. It's completely in the lease. But the court's going to see that as two separate contracts, and they're not going to. All they did was they did pass tenant rights. They did that a while back that says if you're renting for fair market rent and the bank comes in and forecloses, then they're going to start collecting your payments.
But what does it mean that they're going to see it? They're going to see it as two separate contracts. But what does that mean?
So you have a homeowner and a renter, right? A tenant.
Yeah.
And they are signing a lease with each other that homeowner Bob is going to rent to Sally Joe as a tenant, and they're going to give her, peace and quiet and enjoyment and use of the premises, unlimited use of the premises, as long as she's not using it for anything illegal. There's little provisions in the lease. She has free rights to this property as if it's her own, just to care for it over the period of 12 months for $1,000 a month, and that's her contract. At the end of that contract, the seller or the homeowner doesn't have to renew that lease.
But Sally Joe's not on the hook for anything, right?
Well, they have to fulfill their term of the lease. So if they signed a lease for 12 months, they have to pay that lease for 12 months.
So let's say the homeowner goes into foreclosure. Let's say the house goes into foreclosure, and the homeowner basically loses the house in June.
No, the tenant landlord law that has been passed, and I'm not preaching law. We can connect you with a real estate attorney if you want to get this information. But in short, the way it's been explained to me is it would protect them. So if they had a lease from June till June and the bank forecloses in May or April, the bank has to give them the rest of the term of their lease. Unless they're renting it for $200 or something that's not fair market rent, then they say, well, this is clearly probably a non-arm's length transaction on this lease, which means they're renting it to their cousin for $200 or whatever.
How long did it pass that law?
That happened. I'd have to look to see. It's called the Landlord Tenant Act, and it passed several years back. I don't know exactly when. But when a lot of this stuff started happening, that's when they passed it. And we had a client actually one time that wanted to buy the property that she was in, and something happened with her and the landlord, and we don't really know the details, but I know that she, when you go into the fault, they will send either a process server or a sheriff to the door to try and serve you your legal notice and file your lis pendens, meaning they're starting the foreclosure process. So sometimes what happens if the property is being rented, the tenant will be the one that receives that lis pendens notice.
Right.
And they call the landlord and they go, hey, what's going on? Your mortgage is attached. It says you're in default. Why aren't you paying your payments? Do I have to get out? And they start freaking out.
I've been paying you on time.
Right.
Well,
Exactly. So we had a client one time that, she was upset. The homeowner wouldn't make any repairs. There was all this stuff that was going on. So she said, you know what? I'm going to put the money into escrow. And essentially, whenever we get this figured out, the money will be there. You can go to him or whatever. She actually got sued by the homeowner for not paying her rent and not fulfilling the term of the lease. She got sued and she won. Or the homeowner won. The tenant lost because they viewed it as two separate contracts and she didn't fulfill her contract as a tenant.
Wow. See, I learned.
And he won. She got a judgment placed against her and she had to go private money. One of those ones we were talking about with like 30% down.
Yeah.
She had to go private money until that, she got that taken care of.
Do you see that a lot?
No, that was a rare instance, but it has happened.
I can't imagine. You seem like you're doing nothing wrong. And I would imagine a lot of people don't even know.
They don't. And
you have no idea. I'm paying my rent every month for 3 or 4 years.
And it may have been a while before that happened.
Yeah, I have no idea. Now all of a sudden I've got a month to get out.
The other thing we see too is people will go into a lease and they'll say, oh yeah, you can stay here as long as you want. We're planning to rent it forever. We have a homeowner or a client right now. They're in the process of buying. They're looking with our team and he thought they were going to be there for a long time. They've been there for like 3 or 4 years. Well, they just found out that, the lady got remarried. Then her husband passed away. She was living with him. Well, now she wants her house back. So guess what? She has fully entitled to do that at the end of the term of the lease. She can completely get her house back and move back into it, rent it to somebody else. She can do whatever she wants to do after the end of that lease term. And if you sign a lease for longer than a year, it's not binding in the state of Florida. A lot of people don't know that either.
Crazy. So I got to ask, because this is like one of the things that's, because me personally, I will soon be looking at getting a house, buying a house. And we teased this a little while ago, but is it better to look at houses that are foreclosed on? Does that matter in any way, shape, or form? Can you get a really great deal because the $200,000 house went into foreclosure, so now you can probably get it for $110,000 just because the bank wants to get something?
That in the past that may have been true, but okay. I would say now in the market we're in, it's not.
Why?
The banks are actually paying to have full-blown appraisals on these properties before they relist it. So they've already done a market appraisal that they paid probably at least $300 for, to know right where they're going to relist it. And then they look at comps from the listing agent and they relist it accordingly. And they do not come off of those prices. In this market right now, we're seeing they do not reduce those prices till it's been on the market for at least 90 days or a fair amount of time. And we're seeing where they price them, they're usually getting multiple offers. So a lot of times they're a good deal, sometimes they're not. You have to look at everything. We had a client that Jodine was actually showing him a property and she's like, he loves this property. It needs so much work. She's like, come look at it and see what you think. I looked at it and I'm like, there's no way. You can't even do an FHA 203K on this thing. It's more than $35,000 in renovations. It's going to take so much just to bring this property back up to code, and the bank's thinking it's worth this and they're not going to get it. That property is for a cash buyer that can sink another $50,000 in it at least,
right,
just to make it up to par. So somebody like that might get a good deal at it, because a property like that one I just described might be open pretty much just to cash buyers because of financing. Like, you can't get a traditional loan because the property's in such rough shape,
Right, it wouldn't pass inspections or
right.
whatever.
So we're not seeing them really the stellar deals they used to be. Yes, you might be able to get a deal, but we're seeing, if the value, like let's say it appraises at 140, which they're not going to tell you what the appraisal is. They do it for their own valuation. They may list it at 125 because they know as soon as that property hits the market, it's going to open the floodgates. And then what happens is if they've listed at 125 and they have multiple offers, the bank will come back and say, yeah, we're in a multiple offer situation. They'll have you sign an addendum that says they told you that. And then they'll say, give us your highest and best by Friday at noon, or whatever that deadline is, 24 or 48 hours from that time. And so they will typically, once they pick the highest and best, they'll enter into negotiations with that client.
Okay. Now, is there a better time of year when it comes to, for cars, for example?
Yeah.
The best time to buy a car is like September, October, because the 2015s are coming out, so you can get a great deal on a 2014.
Right.
Is there any... Anything like that?
It depends on who you are and what you're looking for. And the reason why I say that is if you're one of these people that has to look through every single thing, like just to make sure that you got the best deal and you looked at all these properties and, you know, this is the one for the price. This is it. I've been looking for 2 years and this is the one. You know, that buyer might want to wait till summertime because there's typically more inventory over the summertime when people are moving and kids are out of school and that kind of stuff than there might be in, you know, November or December for the holidays. A lot of people actually might even take their house off the market during that time period because the holidays are here, and if they're living in there, it might be a little bit of an inconvenience.
Sure.
You know, because again, the seller has to pack everything up, keep the house clean, vacate for an hour, let random people in their house to see it, and then come back, you know, and then maybe start dinner at 7 or 8 o'clock at night.
So there really isn't a better time of year, but
Yeah.
like you said,
I would
the
say get it, you
summertime
know,
might-
to answer that question, I wouldn't say a better time over another. Like if, you know, you might get a seller that's desperate right before the holidays and they're not going to take their house off the market because they have to sell it. And then, so you might get a good deal on something like that. But, you know, you might not have had as many options to pick from, if that makes sense. Like using your same example as far as buying a car, if you buy it at the end of the year, most of those year models are going to be already gone. But if you buy it at the beginning of the year, there's a whole bunch, every color, every year.
Right.
But if, you know, if you're buying something that close out the end of the year, you know, you might get a great deal on the car, but it might be yellow. Right?
And nobody wants a yellow car.
Well, you
I'd be
know
like,
what I mean.
You might get a purple house. I mean,
That's
who wants a
right.
purple house with pink shutters?
But you got what I'm saying, right? You got the point.
Yeah, it's just like Katrina Barbie. Is this like Tampa Barbie with a purple house with pink shutters?
The pink, Barbie pink, hot pink.
Malibu Barbie.
So you're listening to Tampa Home Talk. I want to give you our off-air number just in case you want to call in or pick my brain a little bit more. Or you didn't have a chance to ask your question. And that number is 813-936-2302. 813-936-2302. That's our off-air number. You can call us there and ask us anything at all that you would like to know. You know, if you're a veteran, take advantage of those zero down programs because it really is one of the best ones out there. For sale by owners, we get that one a lot too. I would say buyer beware on those because for sale by owner, there might be a lot of reasons why they don't want to work with an agent. Sometimes we've seen cases of sellers where they don't want to fill out a property disclosure. And if they work with a realtor, we are going to have them do a property disclosure. And if they haven't done that, then usually a good realtor is going to walk away. So just be leery about that. Sometimes also the house might be overpriced. So, you know, realtor's going to provide comparables or comparative market analysis or data on what other similar homes have sold for, but the seller might say no. You know, we might say it's worth 150, but he might say I want 200. So just be leery about that stuff because you might have expenses like home inspection or an appraisal and you don't get any of those things back. So I would say be leery about that kind of stuff. And that, you know, and we've actually seen cases on for sale by owners where they would even try to talk the buyer into not getting an inspection. Oh no, the house is fine. This is great. We've cared for it. We've done every little thing around the house that needs
People
to be
fall for
fixed.
that?
You don't need a home inspection. You'd be surprised.
Wow.
You know, you're meeting Sally and Joe Smith, and they seem like the nicest people in the world. And they're just moving because they want to go up north with their grandkids, right? I mean, you never know. People have all kinds of reasons and motives, and, you know, it could be another whole legal issue for another day on what could happen if they didn't tell the truth. But
Wow.
anything else? Any closing thoughts there, Chris? In the
I'm
first
good.
time homebuyer world?
I'm gonna try to refrain from jumping at the first house that I look at. But I'll be sure to give you a call before I do.
That's right. Be working with us at Tampa Home Talk. We'd love to have you. We'd love to have the person listening. If you missed any part of our show today, you can check it out in its entirety at TampaHomeTalk.com. We're also available on a podcast via phone and the web. Just look for us at Tampa Home Talk. Thanks so much for joining us today as we talked about the first-time home buyer arena and some of the things that they see. We really enjoyed having you. Catch us here next week, every Thursday and Saturday at 5 p.m. For this week, we're out.
Started without you, so find your desperation, 'cause it's time to go. 'Cause it's a long